Welcome to Introduction to Financial Accounting. The textbook we're going to be using is Horngren's Financial and Managerial Accounting. It's the 4th edition by Nobles et al., and it is a Pearson publication, copyright 2014. In Chapter 1, we are going to be dealing with the basics of accounting and the business environment in which accounting operates. Our first learning objective is to explain why accounting is important and list the users of accounting information. To explain why accounting is important, we need to start with a definition and understand how individuals use this information to make rational economic decisions. First, the definition of accounting. Accounting is an information system that generates and disseminates financial information and processes that information into reports, communicates that information to the various user groups throughout the environment in which accounting operates. Those user groups could be either external, as you can see, or internal. The internal users, that's a separate course which we will deal with, and we'll say a little bit more about that throughout this module as well, deals with employees and managers who use financial information to make rational economic decisions internally that only regarding the particular entity in which they're employed. So, for example, many of you will not be accounting majors, and as a result, you'll be working inside corporations, and you probably will not be, obviously not working in an accounting function. But you could be working as a financial analyst, a budget analyst. You could be working in marketing. And in marketing, you need to know information about pricing products, and that's where the financial information comes into play internally. Externally, we'll be dealing with mostly dealing with in this course, and financial accounting would involve users that are external to the entity. Those would be investors, creditors, insurance companies, financial analysts, and stockbrokers. Financial accounting in this course, the primary importance for us will be the external user. And here, users of that financial information will use that information to effectively evaluate the risks and returns that are involved with a particular investment and to direct their capital to their most productive uses. In other words, you're going to try to invest in an entity that is going to be the most profitable and to give you the highest return on your funds. So if we go to the whiteboard, you can see that if we took financial information and we think about this from a corporation standpoint, this is a corporate entity, and they would then report, let's say, the net income for the period. And that's their profit. That's going to go out to external users. Well, let's say that external user is an investor. The investor makes a decision. That decision might be to buy the stock. And that would bring capital flows back to that corporation. Now, of course, we want to make sure that the money is invested in a profitable organization, and maybe something today that's maybe very promising might be investing in solar power. Now, what you have to think about, going back here, when we think about the corporation, people that help put this information together would be the management. And they also use that information to make decisions as well. So here you might have your internal user. So again, when we look at the corporation as a whole, has, of course, management as an internal user, generating that financial information, using that information, but the external user, which is the focus of this course, would be, for example, an investor. It could also be a creditor, a bank that is going to be making a lending decision. Now, when we think about decision making, our course, Financial Accounting, is going to primarily deal with providing information about the financial position of the company. What's the financial position of the company? Well, that's its balance sheet. Those are its assets, that is, the resources it has to use, and its liabilities. What does it owe those that are outside? And its operations, or its results of operations, which is going to be the profit and loss of the company, and its cash flows. Cash flows are critical to a company in order to enable it to pay off its existing debt, its existing loans or obligations, how it's going to use that cash to invest back into the company in order for that company to grow, and cash is also needed to pay dividends to stockholders. So we're interested in providing this information to external users or external stakeholders. And these multiple users with diverse information needs include individuals, investors, creditors, or banks, of course, the government. And when you look at the government right here, we know that the government would be, let me just add that in for you. The government is going to include, if we look down here, government's going to include the Internal Revenue Service and the Securities and Exchange Commission need information as well. Now, because these groups are varied and because these groups have different needs or diverse needs, we have what we call general purpose reports. The accounting report or the financial statements that we issue externally would be called general purpose financial statements. The general purpose financial statements are designed to provide information that best satisfies all user groups simultaneously rather than providing specific reports for every individual need. By satisfying all of these needs simultaneously, we in fact would be able to provide that information at the least cost. So by doing this, by providing this information simultaneously, we provide it at the lowest cost and the most efficient way. If we had individual reports, and let's say that's for each user, it would be, of course, very costly to do so. And therefore, we do not provide information that is specifically designed for each individual user. If you needed a specific report, accountants do provide special purpose reports from time to time. And later on in the chapter, outside of course this particular module, we will be looking at the general purpose financial statements individually. Now, when we think about the process of external reporting, one of the primary differences that you're going to find is that external reporting is governed by a strict set of accounting principles, which are called generally accepted accounting principles. These are fixed standards. In fact, there's more regulation on external reporting, and that is going to come from not only the FASB, but also the Securities and Exchange Commission. And of course, we're starting to converge quite a bit with international standards. So therefore, we have to think about the rules that are prescribed by the International Accounting Standards Board as well. So when you think about external reporting is governed by a fixed set of standards, and it is more regulated than would be the case for internal uses of financial information. Managerial accounting is going to focus on generating information for, as we said before, for managers or employees for internal use to make effective decisions on a day-to-day basis to operate the company. These are internal decisions, and it would include things such as budgeting, long-range financial planning, making forecasts, also pricing products. So you think about, obviously not everyone here, again, is an accounting major, so you think about forecasting and budgeting as a job that you might be taking internally, working as a financial analyst internally. You might be doing something in marketing where you need to know how to price out the product. And of course, in supply chain, thinking about the least cost way to deliver and distribute the product. Accounting information that is provided internally is not prescribed by a fixed set of rules, so they're not subject to external standards, and the special purpose reports, as we said, that would be too costly externally for all the users. Here we could see that you would have these special reports that are going to be quite often used internally. So because of specific needs, the marketing people have specific reports that they would need to look at. Statistically, the number of customers, the amount of sales volume that was generated in a particular territory, a particular sales territory for the company. So Apple would need to know how a particular store is performing. What is the revenue in a particular mall for an Apple store? At the same time, Apple would look at their online sales. So internally, special reports would go to sales management for online sales, sales management for the retail operation. And again, they would also think about whether or not they should reprice some of their products to try to maximize their profit. So to summarize, let's take a look at our two groups of users. Now remember, financial information, whether it's used internally or externally, is designed to allow the user to make rational economic decisions. On the financial accounting side, we issue general purpose financial statements that are subject to a fixed set of rules and regulations to make decisions such as, should I invest in the business? Is the business profitable? From the bank standpoint, should we extend credit to a company, and could that company or an individual, or could the company pay us back? Internally, employees and managers are going to be using financial information to determine whether or not they should make specific decisions. And again, these management accountants are not subject to any specific rules or regulations. Now, of course, there are other regulations with respect to paying taxes and environmental protection, consumer protection. That has to be considered. The FDA, the Food and Drug Administration, so they are regulated. But with respect to the information that they generate, they can generate special purpose reports. The form and content of those reports are not subject to regulation. So, again, the idea of determining how much of their profit should they invest back into the business, should they expand to a new location, and when they budget, how much could they afford to expend going out into the future. Now, the accounting profession, of course, would include positions that encompass both internal and external users. So accountants are needed in business, government, and education. And typically we think of the CPA, and of course the CPA exam is a national exam that is governed by particular states, but it has 4 parts. It has the financial accounting and reporting, auditing, business environment concepts, and regulation. The CPA can work internally or externally, and the CPAs could be employed both in public accounting, that is, auditing firms or firms that provide assurance, or you can work within a corporation called private accounting. When you work in public accounting, that means that an auditing firm is hired by a corporation in order to attest to the validity of the numbers or the information they provide in the financial report. In public accounting, we have expert services, and those services could either be, and again, the firms PricewaterhouseCoopers, PwC, Cohen Resnick, they offer assurance, auditing, so they ensure that the financial statements give a fair, not an exact, but a fair presentation of their balance sheet, their assets, liabilities, and their capital, a fair presentation of their results of operations, which are their, of course, profit and loss statements, and a statement of cash flows. They also provide tax services and advisory services. The CPA firm, particularly when they provide services such as assurance, must be independent of the corporate entity or the municipality or the individual which they serve. When we think about these individual lines of service, auditing or the assurance function, again, we examine the financial statements, and I want to emphasize, we examine the financial statements in order to determine whether or not the information provided presents fairly. It's not accurate. They know that it is accurate only to a certain extent, so that all material errors are found, or to the extent possible, the errors that are there are not significant or not material. When we talk about materiality, when we say something is material, we mean significant. And by significant means that it can impact judgment. Or impact the decision maker. So again, material means that it is significant, and that means it would impact the judgment of a user. So it impacts a user's judgment. And that would mean that they would have some effect, or it would influence the way they think about the company, the way they view the company's financial statements, the way they view the company's income, its profit, or its loss. So fairness means that there are no material errors. No material errors in the financial statements. Now, the next line of service is taxation. So it's either advice, tax planning, or preparation of income tax returns. And again, the same thing, obviously the client has to provide documents that have to be examined, whether it's assurance or taxation. And again, the difference here is that when you do the assurance function, this is going out to shareholders. And for the taxation, this is going out to the IRS or the government. State and local taxation would be the agencies that would be reviewing that information. Now, of course, you could also provide advisory services, and advisory services are going to be where you would either install or advise on information systems. You might be thinking about looking at a company's computer system or its internal controls. Internal controls are extremely important in order to ensure that the information provided is correct. So an example of an internal control, if you work, let's say, at a bank or in a retail store, at the end of the day, the cash register has to be closed out. You have to make sure that all of the cash can be reconciled. So a beginning balance of cash, cash receipts, and any cash disbursements that may have come out of that register have to be duly noted. Typically, someone who is not working the register would close out that register at the end of the day. Same thing. If an individual approves an expenditure, that cannot be the same person who writes the check. So, for example, if you're working in a corporation and you need to order something, that order has to be given to a manager. The manager approves the order, and then someone else would write the check. You would not write corporate checks for something that you're going to be buying for your own use within the corporation. So again, you have financial services. They also look at, for example, mergers and acquisitions. We know that AT&T recently acquired DirecTV, and therefore you can be working in a public accounting firm in a very similar capacity as you would at an investment bank. And as a result, that would allow you to give advice whether or not AT&T should acquire DirecTV, whether or not AT&T should pay a certain price, whether they should use cash or shares of stock. There's also advising on information technology. Obviously, audit analytics is an up-and-coming part of the profession where we use computers and other technology in order to uncover material errors in the financial information within the company's information system, and also management advisory services. Corporate accounting. Careers in corporate accounting may or may not require a CPA. Here you work inside the corporation, and you could be a general manager, a cost accountant. Now, when we say a cost accountant in here, when we think about that profession, here is where you get involved with pricing. How to price out a product. So when you take management accounting, which would be next semester, you would say, I have a product, a new product, how do I price it? I have to consider the market, I have to consider my costs, and I have to consider what I believe to be a profit margin that I would need in order to be profitable for the year. So you would have controllers internally, financial analysts, systems analysts, internal auditors. These folks are doing the same thing as the external auditor, except that they're doing it inside the firm as employees. They're not independent, where the assurance function that we mentioned before, you'd have to be independent. And of course, there are tax managers as well. You could be working for corporations like Apple, Toyota, and the National Football League. Many of the positions internally may require a CMA or a certified management accountant, which involves another exam that would have to be taken. And finally, of course, we have governmental accounting, and here you could be working for federal, state, local governments. You could also work at the federal level, which would be at the Internal Revenue Service, the Securities and Exchange Commission, and the Federal Trade Commission. The Securities and Exchange Commission, of course, would oversee the accounting profession in terms of the financial standards that we issue. They also require reports each year for publicly traded companies.